So here's a simulation based valuation of the S&P 500 for October. Now today we're on the 21st of October, and this number here is the most recent high top of the S&P 500. This is the earnings for 2021, and this is I'm getting this from Yardeni Research, Yardeni.com. And here are the earnings. This is the earnings increase predicted percentage for 2022. So it's 3.1%. So that would take us to 211.55. Now, if I change this to 5%, then I get a number that is closer to what is being estimated by Yardeni Research. And today, bond rates for the 10-year are at 4.221. And notice that the two year rate is 4.481, which is the predicted Fed funds rate in the near future. So these numbers are changing as I speak, but they are higher than the current 10-year rate. This could go down, but then we would have this could go down below the 3 month, and that would indicate a recession coming. So let's assume that this number does not go down below the 3 month, and the 3 month today is this number. So we would have 4.046. So this would give me a fair price for the S&P 500 of 2,662, which is close to the COVID lows. So I go to Yahoo Finance, enter symbol for the S&P 500, go to full screen. I can see that the bottom here for the S&P 500 at lows for COVID was actually around that number that I just saw, 2,300. So it looks like this could go down close to that value. That would be a fall from the top of 44%. Now, if this 10-year uh, number goes to the Fed funds rate, goes up to the Fed funds rate level, which would be predicted by the market right now as 4.479, then we would have an even lower fair price from the S&P 500 and a drop from the top of 50%. This considering an earnings growth of 5%, which is, and this is it is nominal growth. And notice that this is not real growth because inflation right now, according to the at least based on the CPI, is higher than 5%. The latest inflation rate that we had is, in fact, if I go to trading economics, I'd get the latest indicated inflation rate for the United States. That would be the CPI. So that's 8.2, we can even take a look at the forecast and forecast the forecast for inflation rate would be, so the forecasted for Q1, Q2, and Q3 is shown on the last three rows, and Q4 also. So this would be, the first would be Q4. So let's see what we have for the United States. So we have 7.8 for Q4, 6.9, 5.4, and 4% all the way toward the end of 2023. That would be the last quarter. So it's fairly uh, reasonable to predict that the Fed funds rate will go uh, higher than it is now within the next, maybe by the end of this year. And the 10-year rate may follow. And then we have now the 10-year rate may drop significantly because the market will see uh, the recession coming. So there will be a yield curve inversion. So that will uh, um ease economic conditions a little bit, but since many rates are lending rates, they are tied to the 10-year rate. But we know from previous recessions that the yield curve inverts and then it uninverts, and then we have the recession. So we would see a drop, significant drop in the S&P 500 before that, because the market tends to predict what will happen with the economy. So to go to the uh, Fred 10-year minus 2-year, it's already inverted, significantly inverted. But if you go to the 3-month 10-year, that is not inverted yet, although, oh yeah, it's already inverted. It was a minor inversion. But what tends to happen with these inversions is that they occur before a recession. The inversion occurs and then the curve steepens, and then we have the recession. So the inversion is not when the recession happens, it precedes the recession significantly, which might mean that we will have even higher 10-year rates at that point. But then again, the market will probably correct for this um, beforehand, and it seems like the market is significantly mispriced at the moment. So right now, the markets, the S&P 500 closed at 3,752, which with this expected earnings growth, um, we would be expecting a major action. The market seems to be predicting major easing by the Fed uh, happening very soon. Otherwise, the market is really mispriced and it's inconsistent with what we see from the Treasury yields market, the Treasuries market. So it does seem that this is a reasonably likely scenario. Um, if the Fed funds rate were to go down dramatically, let's see how much it would have to go down for us to have this price that we have today as a reasonable, fair price for the S&P 500. Uh, in order to estimate that, I could just change the 10-year rate and see how that number would look like. Looks like I have to change a little bit the size. So 2% under the current conditions is too much. So we would have, let's see, 3%. So yeah, the market is pricing a 3%, 9%. I would normally do this with goal seek, but I don't want to have to access that function. So I did this manually. So the market seems to be pricing in a 10-year rate coming soon of 2.9%. And this is the stock market. The bonds market is predicting that the Fed funds rate will soon be 4.5%, and the 10 years should follow uh, that Fed funds rate if the Fed were to raise it to 4.5 and keep it that way. And if you look at the inflation forecast, which assume this tightening, this Fed fighting inflation, uh, you can see that inflation, CPI inflation, is unlikely to drop so quickly as to make the Fed reverse course. So, yeah, so we are looking at something significantly more, barring some catastrophe, we're looking at something a bit more like what we have today. And if this were to maintain itself, we would still be have a fair price for the S&P 500 of 2,500. So it looks like it could go down to levels that would approach the COVID lows. And this concludes this demo. Thanks for watching.